Hi, Dominique, and welcome to another edition of The Week Ahead. Sorry, I was not able to perform my weekly duties the last 2 weeks, but now I'm back and super excited to get your thoughts on everything. You're out, you're definitely at a consensus call on a potential hike, and again, also probably you're at a consensus call on much reduced optimism on a deal coming, especially this weekend. So first, let's kind of, as we always like to do, get your thoughts on a recap of the past week, I guess, data, events, market reaction, and obviously politics as well.
Hi, Andre. It's really great to have you back, and still with the palm trees swaying in the background. I need to move where you are. Yeah, the recap, lots going on. So the Fed, I'm actually thinking that the conversation we just had with Powell and Bernanke is not as dovish as the market assumed. Powell didn't preclude a hike in June. All he said was that a year ago, there was only one direction for rates to go, and that 510 basis points later, there is more uncertainty on the direction, and the Fed will take its decisions based on short-term data. And, given the growth and inflation dynamics we're having, if, for instance, we got NFP above 200,000, the core CPI, so the super core services, excluding housing, above 5%, I could see the Fed hiking just for risk management purposes. However, there is going to be a little distraction for the Fed, likely to be the debt ceiling. The parties are very far apart. It's not very clear what the negotiating strategy of the administration is. The Republicans just walked out. I believe initially the administration wanted to do a form of brinkmanship, basically tell the Republicans that they were not prepared to discuss any conditions on raising the debt ceiling. But then we got confusing signals from Secretary Yellen. One of the things the administration had threatened to do was to issue debt above the ceiling, arguing that the 14th Amendment of the Constitution allows it, and basically there the Republicans to prevent it from doing so. So that was the brinkmanship. But then we've had Secretary Yellen backtracking and saying that issuance above the ceiling would be illegal, and so it's not very clear. They really have a muddled strategy. Initially, they did not even want to discuss the debt ceiling. The first meetings I had with the senior congressional leaders, in their mind was about the budget and not the debt ceiling. Now it looks like they agree they have to discuss the debt ceiling, but as I said, yesterday when there was this false headline from McCarthy, he was misquoted saying, deal next week. The parties are very, very far apart. So I still think that on balance, it's more likely than not that we get through the X date. I agree with the Treasury and the CBO that there is a risk the X date could be the first week of June. And given where we are in the process, that, it's only on Tuesday that the White House appointed senior staffers to negotiate. There isn't a lot of time to make a deal. And so let's see, maybe we need a big sell-off, which is not happening yet.
There was some talk that both parties were saying that they're pretty close to a deal. Let's just say they were pretty close, or potentially are pretty close to a deal. I'm guessing whatever that deal looks like, the Freedom Caucus, the hard right of the Republican Party, probably won't agree with that. So
No, they said yesterday.
do the parties that the administration and McCarthy think we're going to do this, Democrats and more centrist Republicans, and that's how we're going to get this through? Do you have an idea? Because any real negotiation, the extreme right is one, they don't want to agree to anything with the administration. Two, they may actually, in many cases, want to hurt McCarthy anyway. So they're not dying to make a deal. And clearly they're going to want to draw attention, other things. How would a deal even look? Like, do we know what the negotiations, do we know like, oh, well, the COVID spending, that we kind of agree, but do we know like forcing people on benefits to work, or cutting down this or cutting down defense or whatever? Do we know when they said they're close, what that means?
So they never said they were close. McCarthy was misquoted. And in fact, there was a senior Republican who said so soon after McCarthy.
Right.
I think what's going on is that the market has a bias that we get a deal, because in all fairness, we got a deal in all the previous discussions. No, what we know for sure, because it's on Twitter, anyone can see it, and that's why it's difficult to change. The Freedom Caucus doesn't want any compromise to the bill that was passed last month. So you're right. A compromise is going to get passed with some moderate Republicans joining the Democrat. But we are not going to get there until we have, something more substantial than what the things you listed, which compared with 10-year expenditure cuts of 4.8 trillion demanded by the Freedom Caucus. Obviously, that's a non-starter as well. So we're going to find something in between, but it's going to take time. And in terms of, McCarthy's ability to negotiate a compromise, he was elected only after 15 rounds and after agreeing to reinstate a rule that allows any, it's called the motion to vacate, any Republican can trigger a vote to get rid of him, basically. So we'll get there, but I think we need more time, which we don't have. And we need the parties to get really scared. And with the sort of market reaction we are getting, there's no reason to get scared so far.
Right. So besides even getting to a possible deal, there's the point of getting the extreme right, the Republican Party, to agree. And then there's an additional wrinkle, which people are not talking about, which is somebody in the Freedom Caucus could raise that issue, questioning his leadership.
Not questioning, but starting a vote to get rid of him. So, so it will get resolved. I mean, after all, this is not Russia. This is the United States we are talking about, but it will take. I think there's a chance it could take until after we hit the X date. And we will need quite a bit of market volatility, so people get scared and realize this is not a joke. We are dealing with some things that could really cause damage to the economy and the markets.
Last thing on this, so if there is a deal, are there scenarios in your mind that the market may not take it positive? Let's just say one of the deals is significant spending cuts, which may result in much slower growth, which may re-trigger the recession fears. Now, I think you and I and a lot of people think one of the issues that the Fed has had such a hard problem in taming inflation, and probably similar issues in many other countries around the world, is, well, the government's continuing to spend so much. So, and for a bunch of other reasons that we've discussed in previous discussions, now podcast, by the way, is there a scenario where that agreement actually could be taken as negative by the market? Or you think most likely they get agreement, this was a big uncertainty and the markets will rally?
So my base case scenario is this thing gets resolved fast enough before it starts damaging the economy. And that's because, precisely for what you discussed, if there is no deal, what is going to happen is that the Treasury is going to prioritize interest payment, and it has a very high interest coverage ratio, not an issue. And then the Fed will use, the mighty power of its printing presses to make sure that the Treasury can roll over its debt and that there is no major issue with market functioning. So what will happen then is that the Treasury will have to pay non-debt service bills on a cash available basis. So in other words, the Treasury will be forced to go to a balanced budget. And given that the deficit right now is 7% of GDP, there's no question it would precipitate a recession. Yeah. So I don't think this is what they are going to settle for. The administration has alluded to the possibility of issuing above the ceiling by invoking the 14th Amendment. I'm not sure how credible a threat this is. If they did, it would be chaos. The market would sell off so much, people would be scared, and the two parties would be forced to find a reasonable compromise. Because the thing is, if the Republicans force the economy into recession, it's not going to help their 2024 prospects. The administration will turn around and say the Republicans are preventing us from paying pensions, veterans benefit, and so on and so forth. So there is really scope for a reasonable agreement, one that will bring fiscal policy to more sustainable level, because 7% deficit and I'm talking about the actual deficit. So I'm not talking about like a deficit, including the cost of the debt forgiveness for students. So we're talking about something huge here, which needs to be brought down given all the inflation issues we are having. So I think there is scope for an agreement that's reasonable, that cuts down the deficit without triggering a recession. It's just the negotiation process is very dysfunctional. Part of the issue is that in the past, the Republicans have been basically lied to by the administration. In 2013, the Obama administration was telling Congress and everybody that prioritization of expenditures was not feasible, that the X date would be an enormous catastrophe. And after the debt ceiling agreement, the congressional Republicans used their legal power to get documents from the Fed and the Treasury showing that there had been advanced contingency planning, including planning for prioritization of payments, and that the administration had told the New York Fed to basically keep this secret. So there is a bit of a resentment.
There are some other
part, yeah. And that's one reason they are so hardline.
Why did markets react so negative in 11?
So in 11, I think it's a couple of things. The crisis, the GFC was not so far.
Also, we had the European sovereign debt crisis, Greece.
Yeah. And also the relationship between the administration and the Republicans the first Obama administration was very acrimonious. So all those things together. But what's really remarkable is that, so in 2011, you really see the market selling off around the X date, early August, when they had the agreement. By 2013, you couldn't see anywhere in the market the impact of the debt ceiling. So market assumes that it had become a sort of ritualized theatrics, which is not untrue. But the problem is when the parties are so far apart, you need something to bring them together. And that most likely something is actually a big market sell-off. And so it's a bit of a catch-22 here.
Right. Okay, awesome. And I think we're discussing for all our viewers, we're discussing potentially doing some kind of webinar if this continues to be a problem, things don't get settled, and maybe later in the upcoming week. That would be for kind of our pro wealth and potentially prime users. So please look out for that. Okay, so let's dive into the upcoming week. What do you think the key stuff, key data, anything else that our investors should be looking at?
So to be honest, it's going to be all upstaged by two things, the negotiation and then the TGA. We have debt ceiling updates that we put out periodically, but if it falls below, I mean, right now it's about 80 billion. If it falls below 40, I'm going to issue it on a daily basis because it will be very close to the danger zone. But other than that, we will get the typical end of month data. So PCE, personal income and spending. I mean, PCE, I'm okay with the consensus. I think the really key data there will be the super core inflation, so services excluding housing. If it continues to be around 4.5%, it would add to my conviction for, a hike in June, assuming no debt ceiling crisis, which seems less and less realistic. I'll be also looking for a continued gradual increase in the savings rate. The savings rate went as low as 2.5%. Now it's about 5%. It's over the course of one year, it's gone up by 2.5 percentage points. Very gradual, below pre-pandemic, and giving strong support to the economy. I'm also looking for a continued.
Sorry, on the savings rate, what's your interpretation of why that's moving now?
Simply because a growing share of households have spent all of their pandemic money. Yeah, so they are going back to more normal consumption and savings pattern and going back to work at the same time, by the way. The savings rate is important. The other indicator I like is real household income, excluding government transfers. And I like it because it gives you a snapshot of the sustainability of growth without government support. And historically, it's been a good leading indicator of recessions and recovery. And it's been growth in that indicator has been picking up. So I'd like to see a further acceleration in growth as a sign of the robustness of the economy. Then we get the second estimate of the Q1 GDP on Thursday. And there, the first estimate included a really crazy increase in car consumption, 45% quarter on quarter, which, when you get a number that is that much of an outlier, usually it's revised down. So I'll be looking for revisions to PCE. Other than that, we'll have durable goods. So it's one of those post-pandemic indicators that everybody looks at because it is in the Bloomberg calendar. But to be honest, it's been flat for about a year, and yet we've had quite a robust expansion in non-residential investment in GDP. So it's there, and it's probably not going to move much. Then we have a slew of business surveys. We have the S&P PMIs, we have the Richmond Fed, Kansas City Fed manufacturing surveys. We also have the Chicago Fed National Activity Index. I mean, the consensus for the S&P PMIs, which are probably the more important of the lot, seems to me a little pessimistic. I mean, it's decline or manufacturing moving sideways when you look at the strength of the labor market. So we'll see. And then jobless claims, you know, there has been a lot of worry about the increase, which, I mean, again, if you just plot the data on your screen, you'll see that over the past few months, it's become much noisier. So
some of the numbers are driven by fraud claims.
Exactly.
Yeah.
Exactly. So, you know, we've had a decline this week. I think there is a distinct possibility that it will fall further. Hopefully, the Massachusetts Unemployment Office cleans up its act and we get less noisy data. So that's about it. In terms of Fed speakers, we only have 3 lined up, possibly because it's a week before Memorial Day. And maybe they are, you know.
And my birthday.
That's it, you know, very important events this week. So that's about it. Yeah.
But interesting, you know, with all the fears about debt ceiling, I guess in reality, as you thought, it was false optimism. Markets rally, but you know, even the 2-year yields, you know, we had I'm just looking, we had like almost 25 basis points higher in yields, in 2-year yields, from under 4 to, you know, to 4.25, which is quite interesting considering, again, people were really worried about recession fears, and it just doesn't look like that's happening. So as always, wish all our investors advice, you know, the best of luck. Obviously, you know, ask us any questions for all of our clients. But you've had some amazing calls, but this should be an interesting one. Less about economic data and more about politics, and probably you would even say kind of game theory.
Sure.
Different possibility stuff, which is actually originally a lot of my experience very early in my career. So it was super cool. As we often like to do, I'll just recap a few of the interesting pieces, certainly on the pro and wealth management side and the Macro Hive wealth side. Bilal just released his macroscope, going through what the different triggers for actually a debt crisis in his macroscope. And it's also, macroscope is always a good summary of kind of our overall views, top trades, everything that goes with that. Oil weekly, adding to your higher yields, are certainly higher for longer. From Varesh, looking at stronger demand. Obviously, we've been held in a fairly tight range in oil. And super exciting on the rates weekly. So rates weekly is usually kind of on one specific US or UK market. We've now looked to cover all US, UK, and Europe markets each week. And in fact, in the Global Rates Weekly, and that's Mustafa and Henry together. And this week we look at kind of playing different curve expectations between the US and the UK, which I think actually makes a lot of sense. I really like that idea of thinking. For those people who don't know, we've launched a Macro Hive wealth offering this Monday. We've garnered some interest, well, actually, amazing amount of interest over the past couple of weeks for people who have interest in participating. So right now, this is a beta offering, really targeting to family offices and private wealth managers. You can just email me or ping me on Bloomberg, or even just hit us at info@Macro Hive asking more questions. We just need a little bit of info about yourself, because this is kind of we're trying to be very selective about who participates over time. Not just there'll be amazing content, but there'll be eventually in-person meetings, webinars, meetups, and even discussions more and adding value in private markets. So that should be super exciting, and the feedback we've gotten so far has been amazing. Dominique, I don't know, any parting words for our viewers?
As always, please keep the feedback coming. Negative feedback, especially helpful. And other than that, good luck. And I hope everybody gets a good weekend, because it's going to be a very eventful week.
Yes, great. Thank you so much. Good luck, everyone.
Bye.